Okay, so I have a quick question for you. So let's say that you've been eyeing this stock for quite a while now. This is Disney, and you see that the price right now is $103, and you tell yourself, you want to wait for a retracement before you buy it. So your plan is to buy at $95. Okay, so there is two options. Let's say the first option is that you wait till the stock comes down to $95 to get filled. So let's say it comes down here and you want to get filled at this price. So that's the first option. Now the second option is to wait till the stock comes to you, right, to $95, and then you get filled. And on top of that, you get paid an additional $619 just for buying the stock. So at the end of the day, you will be long 100 shares at $95, and then you also get $619. Now, which would you choose? Okay, so you might be wondering, Davis, is this a trick question? Of course, I would go for the option B, right? I mean, who wouldn't, right? Because you'll be getting paid an additional $619 on top of the stock that you've gone long at. So is this a trick question? Is this some kind of catch? So the thing is that this is not really a trick question. It's not a catch. And the thing is that this is actually happening all the time. And the reason is because, people have no idea that there is an option B. All they know is that, as a traditional, investor in the stock market, all you would do is just place a buy limit order at the place where you want to buy, and then if it comes down to your price, you get filled, right? But they have no idea that there is actually an option B, so they have no idea that they can actually do this. So I want to share with you today what is this option B, how you can actually get paid to get filled to buy the stocks that you want. It's quite a big payout as well. So the way you can get option B is simply by using the put ratio spread to buy your stocks. All right, so what is the put ratio spread? So the put ratio spread, while the name may sound a little bit daunting, it's actually pretty simple. It just consists of two spread. Okay, it consists of the bear put spread and the cash secured put. So I'm going to very quickly explain what is the bear put spread. So the bear put spread, as the name suggests, the bear is that you have a bearish direction on the market. That means you think the market is going to go down. So let's say, for example, you see that the market is making a lower low and a lower high, and you think that it's going to continue going down. It's going to go down. You want to make money on this move down. So what you do is you buy one put option. So a put option basically means that you are bearish if you're buying it. All right, so you're buying a put option, you bearish it, and then you sell a further out of the money bear put option. So this becomes a bear put spread, right? So you have long one put option and you're short one put option. So for example, this is 100, this could be 95. So what you're essentially trying to do is capture the profit from here to here. This is where you will make your money. Now, if the market goes below $95, the max you will make is past only up to $95, only up to here, because you've already kept it with this short put down here. So you have a long put and a short put, and your max profit will be down here. So how much is your max profit for this? So you can see we paid $1.59 for this. Okay, to know what is your profit, very simply, you just take the spread difference, the difference between the spread. Down here you can see this is 5 points. So 5 points you minus the amount that you paid. So it's $5 minus 1.59. That will give you roughly $3.41. Alright, so your risk to reward on the bear put spread for this is roughly 1:2. Alright, so that is the bear put spread. Now the cash secured put, I've explained it in another video in very great detail. You can go ahead and watch that video. Put it somewhere at the top right corner where you can click the link to watch this video. So basically what it is a option where you're selling it. You're selling a put option in hopes of getting filled at the strike price which you sold it at. So you receive a credit for this. Now the put ratio is just a combination of this. So if you can see, for the bear put spread, we are paying a debit for it, right? We are paying $1.59. Okay, so the issue with the bear put spread is that because it is a debit spread, which means, let's say for example, you have already bought one put spread and then you sold one put spread down here. So it means that if the market does come down, you make profit. But if the market goes back up, you will lose this debit spread. You will lose this amount, $1.59. There will be a loss at expiration, right? If it goes above the long put strike price. Now, the reason we want to sell this short put is so that we can finance the cost of this debit spread. You see? So if we're receiving $2.78 for the short put, we bought the spread for $1.59. It means that we have this spread down here for free. On top of that, we even get a credit, right? So you see, if we were to route this put ratio spread, we get a credit of $1.19, right? So per contract, that is equals to $119. So the put ratio spread is a credit spread, all right? The whole idea for this put ratio spread, which we are going to be using, is to get you to buy stocks, all right? We're going to get long stocks. So each short put which we have in the put ratio spread will be 100 shares. That means we're planning to buy 100 shares. So this is essentially the put ratio spread. So we're going to route it as one order. You can see down here we are buying one put strike at the 100 and we are selling two puts at 95. So again, embedded bear put spread, and then you have one short put. So by the way, if you've enjoyed this video so far, I'd appreciate it if you hit the subscribe button and just give a thumbs up so I can create more videos like this for you in the future. Alright, back to the video. Okay, so let's compare the traditional way of getting a long stock, which is to place a buy limit order, and then let's compare it with a put ratio spread to see how it works. We're going to break down the different scenarios as well. So the first scenario for this, all right, coming again to Disney, is that if Disney is above $95, so anywhere in this highlighted box down here, so what happens, right? You do not get filled. No money received, right? It doesn't come down to here, so it's straightforward. You just keep waiting until the stock comes down to your buy limit order to get filled. Scenario number 2 is if Disney goes below $95, right? If it goes past here, immediately your buy limit order will get filled, and you are now long 100 shares at $95. Your cost price is very simply $95 times 100 shares, $9,500. Now let's compare this to the put ratio spread. So the put ratio spread, if you recall, we will be selling this for $1.19. All right, let's say we are doing this put ratio spread where we are buying the 100 put, and then we are selling 2 of the 95 puts. So again, the bear put spread embedded in here with one additional short put, which is the cash secured put. So let's take a look at the 3 different scenarios. So the first scenario, again, if it's above $100, so above $100 is because this is where our long put strike is. So anything above there, our bear put spread actually expires worthless. We do not make anything from there. So all we make is this credit. All right. So you see, this is the beauty of the put ratio spread. If you just did a bear put spread, all right, as a trade, if the market goes up, you don't make any money. In fact, you lose money. But in this case, you actually get to make $1.19 in credit, which is $119. Okay. So scenario 1, if Disney is above, you make money. Now scenario number 2, so let's say Disney settles somewhere between your bear put spread, right? The long strike and the short strike, 195. So how much do you make? So this comes down to exactly where it is when it expires, right? When the option expires. So let's say, for example, Disney comes down to $99. So if it's at $99, how we calculate the profit is basically, again, the credit which you receive for selling the put ratio, $1.19, and then we take the difference between the long put strike and where it expired, where the stock is at expiration. So let's say if it's $99, so 100 minus $99, that's $1. $1 plus $1.19, that's $2.19 in credit, and receive $219 down here. So we have received $219 and we still haven't got our shares yet. It hasn't even come down to $95 and we already made money, right? If you had a buy limit order, this would not happen. Now, what if the stock came down to $97 at expiration? So same thing, $1.19 in terms of the credit, and then you take $100, the long put spread, the long put strike, and then you minus off the price where it closed at $97, and that gives you a total of this should be $4.13, because 100 minus 97 is $3 plus $4, so this should be $4.13. So the total should be $419. So at this point, when the stock comes down to $97, right, at the option expiration date, you do not get long any shares, but you already receive $419. So can you imagine that? You get paid $419 just for waiting, and now you can just sell another put ratio spread again. Okay, so at this point, your cash secure put will expire worthless. All right, so scenario 1, we make money if the market goes up. Scenario 2, if it comes down in between our bear put spread, we still make money. So let's take a look at scenario 3. So scenario 3 is if Disney is below $95 at expiration, and this is the scenario which we want because we want to get long at Disney or for Disney at $95, right? So this is where we actually do want it to go. So the total profit will be $1.19, the credit, plus the full profit of the bear put spread, 100 minus 95, that's $5, total $6.19. So that's $619, and now your cash secured put get exercised and you're long 100 shares at $95. So now your effective cost of the shares is $8,881. You just take the cost price of what you bought the stock for, $9,500, you minus off the credit, the total profit you receive. This is your effective cost of shares. So what this means is that your effective cost, which you bought the stock at, is actually $88.81, right? So imagine this, you place an order to want to buy at $95, but after this whole spread expires and it's below $95, it ended up that your average cost price is $88.81. That is so much lower compared to if you were to place the buy limit order, right? So if you were to place the buy limit order, if you remember, this is just what happens. The price comes down, you get filled at $95. The only way you're going to make money is just by waiting for the stock to eventually go back up again. That's all, right? If it goes down to $90, you're going to lose $5 per share. But if you were to sell the put ratio spread instead, look at this. If it comes down to $90, you're actually overall still a profit because your average cost per share is $88.81. So that is why I said that if you want to get into the stock market, rather than just placing a buy limit order, which you're missing out on the option B, it's much better to sell a put ratio spread. So again, let me just show you. Remember option B. This is the thing that many people, many stock investors just miss out on. They just didn't realize that there is such an option. So with the put ratio spread, you can actually do that. All right, so how do you actually place a put ratio spread? I'm going to go to the TD Ameritrade platform and then just show you how to place one. The first thing you want to do is take a look at the option chain. All right, so for the put ratio spread, generally we want somewhere between 30 to 45 days because after all, it is a premium selling option. So we do want the decay there for the additional short put which we have. So ideally we want anything between 30 to 45 days, so there's some good data decay as well. So for this, I'll take a look at the 19th August 22. So there's 29 days left to expiration. So what I do is very simple. First of all right, you go down to see where is the at the money. All right, you can see that right now AMD is $91. So this is where the current market price is. So the next thing I want to identify is where I want to go long, right? Where's the place where I want to buy 100 shares of AMD. So what I do is I will go down to the charts. Okay, so as you can see, this is the chart. This is the weekly chart. I don't want you to see this for now. Let's just very quickly take a look at the daily chart. So let's say for the daily chart down here, the price has gone up quite a bit. So let's say I want to go long. I think let's say I want at 80. Okay, if I want to go buy my shares, 100 shares at 80, I'll go ahead and take a look at the options chain and see what I can get for this. All right, so the way I would put on the put ratio spread, just simply do this, analyze sell and do back ratio. Okay, so this is the ratio spread. So you can see again, you are selling 2 at 80 and then buy 1 at a strike price. So this is where I want to adjust. So what I'm looking at is I want to see how far I can go in terms of how big the bear put spread I can get. So I'll try and see maybe if I can get 85. So if I can get all the way to 85, you can see I can get a credit still. So let's see if I can push it a little bit further. If I can do 86, I can do 86. Let's see if I can do 87. Now, if I reach 87, I see this is debit, then most likely I don't want to go there because I do not want to pay for the put ratio, because in case that AMD continues to go all the way up, it does not drop below $87, then I'm going to have to lose this, 13 cents. So instead, I always want to route it for a credit. Now, you can choose to route it for a bigger credit. Let's say if you go to 83, you notice that you get $1.15 in credit. That means that if the market goes above $83 or stays above $83 at expiration date, right, you'll pocket the full credit, which is $1.15. But if the market actually goes down, right, it goes down below $80, right? You'll get filled at $80, but the max profit you would get on the total would be only $1.15 plus this $3, which is $4.15. So $415. But if you were to do it at 86, right? So you notice, remember, the profits which we will get will be the difference between these strike prices plus this credit, right? So in this case, if it does go down to $80, below $80 expiration, then the full profit I would take would be 6 points plus this credit, which is $622. So now it comes down to just, asking yourself which one you would prefer, right? Would you prefer to receive a bigger credit upfront, but then if the stock comes down, you receive a total lesser profit? That means your break-even cost, or rather your cost price, the effective price of your stock would be slightly higher than if you have changed it to the 86, right? So for this, we can see on the chart how does it look like. All right, so we know $80 is here. So let me just pull up the drawing. Just pull up the price down here so you can take a look. So at $80, all right, let me just change this to 80. All right, so this is where we will be short 2 puts. All right, let's put it in red. So we have minus 2 puts. So we know this is where we will get filled at if the market goes down. And then we have another one at $86. All right, $86. Let's edit this. So this is plus 1 put. So we're buying a put option here. Let's just change the color of blue so we know that we are actually long this put. So long this 1 put, and then we are short this 2 puts. Okay, so from here you can see that if the market was to come down below $86, we will have a profit, and if it goes all the way down below $80, we will take the full profit of this. So if you feel that AMD might go up a little bit further, or you want to receive more credit up front, you can actually change it, right? So we've already seen on the option chain, right? We can change it to 83. If you change to 83, you'll be receiving $1.15 credit up front. But that also means that you do not make as much if the market actually do not go below $83. So you can see $83 is somewhere here. So let me just change this. There you go. You can see that it's very small. All right. So this really comes down to how you want to manage it. Okay. Now you might be saying that, hey, this is actually quite far away. What if I try to move it closer? What if I want to get long 85? Then you can do that as well. You can just change it. All right. Shift this to 85. And then you can probably do this to around market price, right? Now it's $91. Let's shift it to 90. Let's see whether we can get a credit for this. As you can see, we can get $1.27 in credit. So it's $127. At the same time, if it goes below $85, we will be able to get $5 profit, which $500 for this embedded bear put spread here. So total of $6.27, right? That's pretty nice. And in fact, you can even push it even further, right? You can even go $91. You can even get the long put in the money, right? If you can see how far I can go to, all right, 92.5 is not traded, 93, no, 93 is not traded, 94, all right. So I think 95 will be a debit for sure. All right, so this debit, we definitely don't want to go there. So you can see $90, all right, the most we can push it to $91. So this is if you're a little bit more aggressive, right? So that means you do not mind that you get filled at $85. So let's change this to $91, all right, and then change this to $85. So you can see that it's much easier for you to get filled right now because you can see that the market is pretty much overbought, right? It's quite extended. There's a very good chance that the market will come back down, and see how far it can come back down. So if it does come back down, what you'll be doing is that you will definitely be getting this profit, right? 91 all the way to 85 to $600 plus the credit of $1 plus. That is pretty juicy, right? That's a pretty juicy profit right there to get long. So if you were to get long, let's say at $85 when it expires below $85, so your effective cost price will be 85 minus 6. So your effective cost price should be around $79 plus or $78 plus, right? Around here, this will be effective cost price, which is not so bad as well, right? So this is how you can manipulate. Now, what if you say that, $85 is a little bit too near, and $80 is also a little bit too near. I want to get further away. I want to buy it at $70. Well, you can, but the trade-off is that chances is that your spread, the distance between these two strikes, is going to be not as wide. Okay, right? Let's take a look. So let's say we adjust this to 75, our short strike to 75, and then let's see if we can get 5 points on this spread as well. All right, we can get 5 points as well. Okay, so actually it's not so bad. Right, we can even get 6 points. Okay, and the reason you can see is because look at the IV. It's 59.81%. Let's take a look at the other strikes. Right, so you can see that it's all 50 something. So MD, right, you can see that it's pretty good, the IV down here, for getting the premiums. So basically, the higher the premium, the bigger the spread you can make it, right? Because you get more credit on your cash secured put. All right, on the short put you get more credit. That's why you could buy a bigger spread. Okay, so you can see for this you can actually put it at 75 to 81, but you only get 1 cent credit. Okay, so let's change this to 75, and then we have this at 81. Right, this means that if AMD do not go below 81, right, you only get $1. Right, that's 1 cent. But if it goes below here, you can take the profit here, or it goes below 75, you belong 75. Right, your effective price, since you're collecting like $6 in profit here, your effective price would be around 69, which is below the previous low, which is pretty good. Okay, so again, you can see this is how you can manipulate it. Now, if you want to buy AMD, right, you actually do not have to place the put ratio spread right now. Okay, you could actually just wait for a retracement, then you sell the put ratio spread. Right, you might say that maybe you let this go from overbought down somewhere down here, then you could say, oh, okay, then I can place the put ratio spread. Maybe I can place it slightly lower, where the additional short put will be much lower, 70, maybe even 65, to try to get a better price. Okay, so you could do that as well. So there's no right or wrong for you to place the put ratio spread, when to put it, because ultimately it comes down to where is the price that you want to buy it. If you're comfortable at buying at $75, then it just doesn't really matter in terms of when you put on the put ratio. Remember, a put ratio spread is a rather slow moving spread. That means it takes some time before you can get exercised on the option expiration date. So let's say this is 29 days. It means that if you want to buy, AMD at the strike price, the short strike price, let's say of 75, it has to be below 75 at expiration date. That means past this 29 days. Okay, past the 29 days, you have to be below here. You have to be below here. If AMD comes down below 75 and then goes back up again before the expiration date, well, guess what? You would have not gotten the chance to get long here because it didn't expire below this strike price. So that is one thing to take in consideration when you are doing the put ratio spread. So let's say you are very eager, or rather you really do want to get long the shares, and at the same time you want to make money on the bear put spread. All right, the other alternative is to use the shorter time frame. All right, if you use the shorter time frame, the trade-off is that you would be having a smaller spread. All right, so let's compare this. Okay, let's say this one at 75 and 81. If you were to do it on this expiration date, chances are that you wouldn't be able to get that big of a spread. Okay, let's take a look. Let's take a look at here. So again, open up the ratio spread. All right, you can see there's only 1 point spread down here, right? 76 to 75. I don't think we can even do a 77. Oh, we can even do a 77. All right, that's a 5 cents credit. Let's see how far we can push this. 78, 79. All right, so 78 is the furthest we can push. There is 3 point spread. So 3 point spread, we get $300 if it goes below $75 in just 8 days. All right, so if the market really somehow, crashes or it does very bad, maybe if there is an earning coming up and then there's a gap down and then it closes below $75 in it after the 8 days, guess what? You'll be long here, and then you get $300 on it as well based on this spread. Alright guys, that's it for this video. Last but not least, if you like this video, please subscribe and hit the notification bell so you'll be informed whenever I release a new video like this. As always, thanks for watching, appreciate your time, and see you in the next video.